everyone, it is Thursday, and you know what that means. It is time for another financial history throwback. Every Thursday, we revisit a financial or economic event that shaped the world we live in today. Because sometimes the best way to understand today's economy is to learn from yesterday's history. So let's get into today's story. For this week, we're looking into the Lehman Brothers bankruptcy in 2008. Imagine being one of the biggest investment bank in the world and then almost overnight your company collapse. No bailout, no rescue, just bankruptcy. That's exactly what happened to Lehman Brothers in September 2008. The Lehman Brothers was founded in 1850 and grew into one of the biggest investment banks on Wall Street. For years, Lehman was heavily involved in the US housing market as it bought and packaged mortgage into financial products and sold them to investors. So, and while the housing market was booming, businesses was booming too. But there was a problem. A lot of these mortgage were subprime mortgage, that is loan given to borrowers with weaker credit histories. So when the US house price started falling and borrowers began defaulting on their mortgage, the value of this mortgage related investments collapsed and Lehman was suddenly sitting on billions of dollars of assets that were worth less than expected. Things got worse as investors began losing confidence in Lehman. The bank tried to raise capital and find a buyer, but potential rescue deals fell apart. Then came September 15, 2008. Lehman Brothers filed for Chapter 11 bankruptcy protection with more than 600 billion in assets. At the time, it was the largest bankruptcy filing in US history. And this wasn't just a problem for Lehman. Its collapse sent shockwave through global financial markets. Banks became afraid to lend to one another because nobody knew which institutions were holding toxic mortgage related assets. Credit market froze, stock market plunged, businesses struggled to access financing, and the financial crisis became a global economic crisis. Why was Lehman collapse so important? One of the biggest lessons was the danger of excessive leverage. Lehman had borrowed heavily to finance its investments. When the value of its assets fell, those debts became difficult to manage. Its collapse also raised the famous question: is a financial institution too big to fail? The US government had already intervened to rescue other financial institutions, but Lehman was allowed to fail, and the consequences were enormous. The Lehman bankruptcy showed that financial institutions are deeply connected. A problem that starts with housing can move to banks, then to financial markets, and eventually affect businesses, jobs, and households around the world. And that's what makes this story so important. A financial crisis isn't just about numbers on a balance sheet. Behind those numbers are real businesses, real jobs, and real people. The collapse of the Lehman Brothers became one of the defining moments of the 2008 financial crisis, and more than a decade later, its story remains one of the biggest lessons in financial risk management. I will see you next Thursday for another financial throwback. Bye.